as investors try to keep pace with the Fed, let's take a closer look at the market action with Principal Asset Management Chief Global Strategist Seema Shah. Seema, certainly a lot of investors got their hopes up last week when we got some of that inflation print coming through, potentially sort of pointing to a cool down or maybe a peak. Sounds like you're sort of in the camp that you think too much optimism too soon.
Yeah, that's right. So I think that, what we can see is, given this peak in inflation, it probably makes sense that they're going to slow down their rate hikes. So we are expecting a downshift from 75 basis points to 50 basis points come December. But that was always actually within the forecast. And I think many people had already been assuming that at some point towards the end of this year or early next year, there would be a slowdown. Inevitably, there has to be a slowdown. But I think the other thing that we've been hearing from a number of the various Fed speakers is just because they're slowing down their pace of rate hikes, it doesn't mean that it impacts the terminal rate. So from that perspective, we are still expecting rates to rise further. We're expecting them to go above 5% at some point in 2023. So a lot of the optimism that is being priced in at the moment is really around this assumption that the Fed is going to stop hiking pretty soon. And actually, we think they've still got some further to go. It's just going to be at a slightly slower pace than we've become accustomed to in the last few months.
So if the terminal rate remains the same, let's say this next meeting, 50 basis point hike, from then on, what does that pace of hikes look like?
Yeah, so I think, look, a lot of it at the moment is going to be, we've been hearing from the Fed that they're going to be very data sensitive. We have to take that at face value and assume that actually the labor market prints, the inflation prints are all going to be part of their reaction function. So how are they going to respond to it? Our best guess at this stage is that you have a 50 basis point hike in December, and then come February, assume that inflation has continued to soften, then we could be looking at a 25 or a 50 basis point hike. And then from there on, potentially another 25 basis point hike. So this is taking you above the 5% level. But as we said, it's slightly downshift. And then from there on, come the beginning of the second quarter of next year, then you have a pause. But I think the main thing that investors have to think about is, although you get a pause, it doesn't necessarily mean that that's a pivot. So it doesn't necessarily imply that once the Fed stops hiking, they're going to follow that up rapidly with rate cuts.
So what does this all mean for the equity markets? We have seen some optimism come through on the back of more positive retail numbers, but certainly at the end of the day, it really is the Fed that's the big driver.
Yeah, and the monetary policy, it works with a lag. It won't hit the real economy for 6 to 9 months from the time it starts. So this is around now, which is when you're going to start seeing that economic weakness really falling through. And certainly the economic data has pointed to stronger consumer resilience than I think many people were expecting. But even then, in 2023 is when some of those rate hikes really come home to roost. You start to see the impact feeding through to the economy, and then earnings, unfortunately, will follow. So we are expecting an earnings downturn to come through in 2023. So although the Fed stops hiking, which of course would be a positive for the market, unfortunately, you feel that second impact, which is the kind of the long leading impact from rate hikes on the economy and on earnings.
Seema Shah, Principal Asset Management Chief Global Strategist. Appreciate your time this morning.